Good morning, ladies and gentlemen. Thank you very much for joining us here today at the United States Studies Center for our briefing concerning the U.S. government shutdown, the looming debt ceiling debate, and its implications for the United States and Australia in both political and economic terms. We're very, very pleased that we're able to also have joining us here today Huw McKay, who is an associate of the U.S. Studies Center and a managing director of the Westpac, a well-known economist here in Australia, who will be able to give us his perspectives from an economic point of view. I am Bates Gill. I'm the CEO of the U.S. Studies Center, and I'm just going to say a few words of introduction in how I read the current situation in relation to both politics at home in the United States and foreign policy abroad. First, just a little bit of background information about what we're dealing with here in Washington today. Believe it or not, the debt ceiling requirement, the requirement for Congress to approve raising the debt ceiling is nearly 100 years old. This is a law that was passed in 1917, and so it's not particularly new in that sense. Since 1980, the debt ceiling has been raised 42 times, including 17 times under Ronald Reagan, 4 times under Bill Clinton, and 7 times under George W. Bush. If we see the debt ceiling raised again in the coming days, that would be the 6th time under which that debt ceiling has been raised during the presidency of Barack Obama. So in that broader sense, the discussions we're having about the debt ceiling as well as the U.S. government shutdown are not particularly new. At the same time, though, I think most analysts would agree that the situation in Washington today is probably about the worst it has been. The degree of acrimony on both sides of the political aisle, even personal acrimony which has arisen across some of the key players, has been particularly strong and has resulted in what has been this rather lengthy government shutdown and the increasing concerns in the United States and abroad that the parties here may well wish to see the debt ceiling question driven right to the edge of the cliff yet again. A lot of the concern in the United States about this situation seems to rest with a relatively small element of the Republican right, so-called Tea Party advocates. And I think that may well be, in part, an explanation. But obviously it's part of a much broader debate, a much broader debacle, really, and concern in the United States about the future of the country and its ever-increasing debt. So I see the convergence today in the United States of 3 problems that are making this the particularly acrimonious issue that it is. First, as I said, there is widespread, although I think still a minority, but relatively widespread view in the United States, particularly, again, on the right of the Republican Party, that the country is moving in the wrong direction. That ever-increasing spending, a so-called socialist agenda of the Democratic Party, represented by President Obama, is taking the nation in the wrong direction. That the very fabric of the country, that the relationship between government and citizens is wrong, and I think even in the view of some, illegitimate, and that's motivating these individuals to take a much tougher political stand, and because many of them have no political downside. There's no political downside, electorally speaking, for them personally to take these positions. They do not see a risk in doing so. Secondly, slightly more broadly, it's also true that it's not simply the right wing of the Republican Party which is helping contribute to the current situation. There is even among moderates on the Republican side, there was seen some benefit in challenging the president, challenging the Democratic Party to be more serious about the debt issues and spending problems which the United States faces for the longer term. There is some political value in undermining the political standing of the president as well as of the Democratic Party as a whole. Obviously, at that level, it's not so much ideological or even existential. It's really more in the way of political tactics to try and gain some upper hand. And then finally, I think we have to recognize that the Americans' long-term fiscal future is going to depend very much on some very, very difficult decisions that have to be made about lowering the cost of government, lowering debt, and trying to introduce more fiscal responsibility, especially at a time of austerity. And in this sense, I think all the parties across the spectrum have to shoulder some of the blame, and there's going to be some very difficult decisions going forward. My sense is that some sort of an agreement at this domestic tactical level is likely to be reached. We've seen the most recent news coming out of Washington over the past day that there seems to be some agreement, certainly within the Senate. I suspect we're going to result in some sort of near-term agreement to kick the can down the road, to allow for a raising of the debt ceiling, to allow for a reopening of the government, but to do so for only a relatively short period of time, a matter of weeks or months. And probably much of the debate right now in Washington is on that number. How long are the Republicans prepared to agree to raise the debt ceiling and to reopen the government? And that we'll have to see. Another interesting point I found on the domestic political situation in Washington is the degree to which, over time, disapproval of Congress generally, true, but that apparently, at least according to a recent poll from the Washington Post and ABC News in the United States, the Democratic side of things does not seem to have suffered all that much in terms of increased disapproval. Rather, it's the Republicans in Congress, at least according to this poll, that is gaining an increasingly larger proportion of blame, if you will, by the American people for the current situation. I think this raises very interesting questions in a broader electoral sense about the future of the Republican Party, certainly at a national level, at a state and national level going forward. Let me just say one or two more words then about how I read the situation regarding American foreign policy. There was an enormous amount of attention paid to the fact that President Obama was unable to travel to Asia, which was going to be a kind of an important pinnacle, an important emphatic point in the president's effort to rebalance American foreign policy towards the Asia Pacific. That did not happen, and of course, being absent from so many important discussions in the region, both at a multilateral and bilateral level, can only be a negative upon American ability to expand its presence here and to be more influential as the rebalancing intends. I wouldn't read too much into this. I mean, obviously, in the near term, I suppose there'll be spikes in terms of appreciation for other countries like China, more praise, the fact that the Chinese President Xi Jinping was also traveling throughout the region and had a number of important discussions and meetings, both multilaterally and bilaterally. All of that sort of adds up in the near term, I suppose, to this notion that America's presence is ebbing and China's is inexorably on the rise. I take a little bit of caution in that sort of a view. Yes, it's true that the president was unable to be here. He certainly will be in the coming months, and I don't think it changes much in the way of American commitment to wanting to continue to expand its presence in the region. But all that said, perceptions really do matter. And I think not only do we hear more vocally now and more publicly, even from American friends, expressions such as unreliable coming to the fore, that ought to be very, very worrisome to those in Washington and all around the world who see real value in strong American presence in the Asia Pacific. I would just note, most recently, just yesterday, I think, or maybe it was earlier today, the Chinese official news agency Xinhua came out with a very strongly worded commentary calling for the, quote, de-Americanization of the world if the United States continued to be as irresponsible in dealing with its fiscal matters, putting at risk the stakeholders and investors, both public and private, through this kind of gamesmanship. The Chinese then say, maybe we need to think about a more de-Americanized world so that we don't have to be as reliant upon what seems to be an increasingly unreliable partner. I mean, I suppose there's lots of reasons for the Chinese to take that view, and we should be listening carefully, and hopefully those in Washington are listening carefully as well. I think we'll have a solution to this in the next day or two, but I think obviously the longer-term impact, both in terms of image, perception, and I think in economics, are the things we ought to be worried about, not what's happening in the next 2 days. And I'm looking very much forward to some words from Huw McKay about what this is all going to mean from an economic point of view. Thanks, Hugh.
Thank you very much, Bates, and thank you to the Centre for the invitation. And I think that those introductory remarks set up what I want to say very well, in the sense that I want to focus on the immediate, but I also want to project beyond the immediate and even the medium term and talk about some of the long-term consequences of what is now some increasingly frequent periods of what I would describe as the US as a dishonourable debtor, in terms of really playing very fast and loose with their obligations to their very honourable creditors. This is the Westpac disclaimer. My apologies for having to push it out there, but we are talking about financial matters, and I'm obligated to do so. The key messages that I would like everybody to leave with today. First of all, that whatever the political outcome that is brokered in coming days and weeks, it is very, very clear that the fiscal drag on the US economy next year is going to be much greater than is currently factored in to the thinking of policymakers and the thinking of financial markets. And once you start to question those assumptions about the degree of fiscal drag on the US economy next year, views of world growth next year, which underpin all sorts of things in terms of financial asset pricing and policymakers' biases about what they might have to do outside the United States, many of those views come crumbling down. If you actually revise down US economic growth in 2014, because whatever deal we broker comes with substantial fiscal concessions, well, you are obliged to remain credible to revise down your growth forecasts. And because the US economy is still the centre of the world economy, that has implications for everybody. And that story, I don't think, is really being played out to the degree that it ought to be in the current negotiations. I am very concerned that we're going to get a benign resolution this time around. I think financial markets have been relatively complacent about this. We've done this many times in recent history, as Bates has emphasised. And so, regardless of the irrationality of the discourse, markets are expecting a deadline deal at the deadline, if you will, and they won't respond with pessimistic behaviour until that's proven to be incorrect. Now, I agree with them to an extent, but I am more concerned this time. I think this particular episode is more troubling than those we've seen in the past. I also want to emphasise the long-term fiscal sustainability of the US economy. The long-term projections are actually very frightening. Even the official figures from the CBO in the United States, those numbers are not something anyone should be aiming for, but it's my personal view that they're actually underpinned by very optimistic assumptions on the three big parameters: spending, revenues, and economic growth. And if you actually change those assumptions just a little and compound them deep into the 21st century, that trajectory becomes very dangerous and very frightening. Monetary policy clearly has less freedom of action now. It was only a month ago that we were angsting about whether or not and to what degree the US Federal Reserve would taper unconventional monetary policy in the United States. Fast forward to today, and that seems to be absolutely off the agenda. The monetary authorities are now extremely constrained by the fiscal policy situation and the potential sentiment impacts of the fiscal policy situation. And the lack of fresh data, which is coming from the departmental shutdowns, just makes it incredibly difficult for the monetary policy to have a decent view about where the economy is today, let alone forecasting it into next year. So the monetary authorities are extremely constrained. Should we be concerned about that in the same way we should be concerned about the US's status as a debtor? Well, no, not from my point of view, because I actually think that stable monetary policy in the US is exactly the right policy at the moment. I didn't think they should have tapered, because I think the US economy is still very susceptible to any kind of drag, and removing some of the monetary policy stimulus or becoming less accommodative would do precisely that. And the controlled experiment we saw earlier this year indicated just how susceptible the housing recovery and household balance sheets and consumer confidence would be to the rise in borrowing rates, which a normalisation of US monetary policy would entail. So US monetary policy is constrained, but that may not be a bad thing. And finally, this episode and those that have preceded it with similar characteristics really does highlight an issue with the global architecture. Xinhua has written in a recent editorial. It's not the first one they've written on this topic. We have a unipolar world in terms of inner circle reserve currencies, inner circle benchmark risk-free assets. All of these things centre on Washington and Wall Street. We need more competition in this space. We need an alternative international vehicle currency. We need an alternative risk-free benchmark. And that competition would impose market discipline on the Congress and give us more reasonable and earlier outcomes once these negotiations come through. And I've used the term deficit doves at the end there, because as I proceed through my remarks, I want to make a distinction between the debt, which is the accumulation of deficits, and deficits themselves, because I actually think that there is a disconnect between how Congress deals with the two aspects of public finance. They actually don't worry about the deficit. Apparently they don't care about the deficit, but the debt they do care about. And that disconnect is not rational, and I'll be going through some of the ramifications of that as we proceed. So just to give you a few basic dates and numbers, and also to illustrate the gross public debt versus the debt ceiling through time, you'll see here that Congress has been very reluctant to give much wriggle room to the budget over time. The ceiling has never really been increased to such an extent that we've just had to set and forget in terms of fiscal policy, giving ourselves plenty of room to operate. Now, the situation in Australia is very different, actually. When we move our own debt ceiling, we do it very decisively, and we'd have great freedom of operation for a period of time. You can see here that with the exception of some moves in the late 80s, early 90s, there's been very, very little flexibility here. Congress essentially giving a very short leash to the Office for the Management of the Budget. And that means that we have to raise this thing far more often than we ought to when just natural economic growth ends up hitting that ceiling relatively frequently. But the key dates, October 17, we run down to the floor where the government has too little cash to meet its obligations. 6 billion of that would go on the 31st, servicing existing debt. Outgoings of 67 billion on the 1st of November. This is not debt payments, this is just the business of government meeting obligations outside of paying furloughed public sector employees. And then on the 15th, a very large interest payment is due, $30 billion. So whilst we hit that floor on the 17th, it is possible for the US Treasury to borrow money up to and including the 31st of October to meet that first serious chunk of money which needs to go out the door. So the 17th is an estimated timeline at which the US Treasury feels they have no flexibility left, but we would still have a week or two's grace for the Treasury to actually get out there if a deal is brokered. Now, and getting on to the economy more specifically now, I've indicated that one of the major takeaways here is we really should be revising our growth numbers down for 2014 for the US and for the world once you go through what any possible deal could look like and what it would mean in terms of concessions on either side. We have some experience on this front, and every time it's come with either sequestration or some sort of concession on entitlement, some sort of concession on other aspects of discretionary spending, and it's always meant that the drag on economic growth from the public balance sheet has increased. Most of the uplift, which you can see here from growth in the calendar year 2013 and 2014, most of that is actually predicated on the fiscal drag disappearing and that manifesting itself in improved economic growth. Now we think that the authorities in the United States actually underestimated fiscal drag in the current year, and there's still some of that to come through. And we also think that fiscal drag should be embodied in 2014, and our underlying growth assumptions are actually a little softer anyway. But if you don't want to forecast the 2.6, which the IMF is now talking about for the United States, and you do build all of this in, well, your 3.6 for the world doesn't make any sense either. The rest of the world needs the US to be strong if they are to grow at their potential rates. If the US is weak, as we anticipate it will be, you have to start making very, very different assumptions about the emerging markets and also the advanced countries. That 1% for Europe, which you look at next year, much of that is predicated on the Europeans being able to sell goods outside the country, outside the zone, I should say. And if the US is softer, their ability to do so will be less. If the US is soft, emerging markets will do less well, and Europeans will sell less goods in the emerging markets. Everybody is linked here. And so there is a cascading effect, a very large cascading effect in terms of growth expectations, which any downgrade of US growth prospects will bring with it. So we shouldn't be under any misconceptions here. This political malaise has economic consequences for the US economy in 2014 and consequences for the rest of us. And if I can refer you to the bottom corner, the Reserve Bank of Australia's view on economic growth here in 2014, that is preconditioned on improvements in the US economy, improvements in the global economy, and the backstop that would give us at a difficult time as we transition away from mining-led economic growth. We're not so optimistic there, and that's one of the reasons why we think interest rates will be coming down in Australia in early 2014 and not remaining on hold. We'll skip over that one and get straight onto the US labour market. Now, the heart of any economy is its labour market. It drives the sentiment of consumers, and the US economy is the consumer par excellence in the global economy. 70% of activity is embodied here, and if the labour market is soft, real wages are not strong, it's very, very difficult to have a vigorous economic recovery. And if you take a holistic view of what's going on in the US labour market, we do not have strength, we have weakness. And it's the sentiment of households which is going to be a very large casualty, one suspects, of the malaise in Washington. So the real economy is not supporting household sentiment, and politics is providing an unwanted negative overlay to match the reality of an economy which is creating part-time jobs but not full-time jobs, an economy where people are not participating in the labour force because they do not like their job prospects. The unemployment rate is down, but the labour market is not supporting Middle America. And the controlled experiment in the US economy, which I've already referred to, the US household sector takes advantage of low interest rates through refinancing their mortgages. This is the key channel for doing so. And you can see on the graphic that the rise in interest rates, which we saw earlier this year, when the US Federal Reserve was hinting that they may taper their monetary policy, we saw a very sharp fall in the number of refinancings in the mortgage market. This is why I think it's no bad thing that monetary policy is actually constrained in the current environment from doing anything in the direction of being less accommodative. The US consumer needs this source of stimulus, and we'd like to think that they will get it because there is a huge emphasis on the private economy to grow in the United States, given that the public economy is removing itself from the conversation as a source of growth. And I just want to make a couple of comments now, and I realise I'm moving around quite quickly, but I also realise my time is short. I want to make a couple of points about the state of the financial system in the United States, the interaction with monetary policy. There has been some healing in the US financial system over a number of years. But once again, similar to the labour market, it's clear that there is more healing to come. If you look at the mortgages on the balance sheet of US banks, they are still down considerably from the peak. And that goes for all aspects of the commercial banking system's assets, besides their holdings of treasury bonds. Essentially, they have not been lending to the private sector. They remain wary about doing so, despite the apparent rally in house prices which we've observed. And if you look at the system overall, you can see from this graphic that, oops, my mistake. You can see from this graphic here that when you actually look at the change in the assets of the financial system from the peak, outside of the Federal Reserve's expansion, we've actually barely gone anywhere. Despite the economy itself being in recovery mode for a number of years, the Fed's balance sheet expansion has only just filled the gap. And if you compare that to the expansion of credit across the economy in the earlier phase, really the kind of financial support for the US economy which we're currently observing, it's at best a holding operation. And that's why we're not as hawkish as some about looking at the raw dollar figures and the size of the Fed's balance sheet, because when you consider the kind of financial backstop for the US economy over the course of the 2000s and what we're seeing now, it's impossible to grow at those rates consistently again if you just don't have the financial system backing it. And the kind of growth rate assumptions which we have underpinning the long-term fiscal trajectory assume we're going to grow at those rates and even faster for a sustained period of time as the economy heals. And I'm very sceptical about that. And finally, some remarks about the longer-term fiscal trajectory. Now, I've taken the CBO projections literally here, and you will see that what is actually categorised as mandatory outlays absolutely taking off in the forward period. Now, what's mandatory and what's discretionary? Well, mandatory is an outlay that you must meet if the individual or corporation meets the criteria. You don't know how many people are going to meet the criteria, but if they fill in the form, the outlay must happen. Healthcare, of course, is a big number here. Discretionary is everything else. Schools are actually discretionary, you know. Public services of many types are actually discretionary. You can choose how many policemen you have, how many firemen you have, how many people man your borders. And defence is also classed as defence is also classed as discretionary. And you might argue that some right-wing Republicans think that net interest bill is also discretionary. Well, that's not true. And the idea that jingle mail exists in the international bond market as well as in US housing is a very, very misplaced perception. But the fiscal trajectory, look at those mandatory outlays. Bates has already indicated some very difficult decisions need to be taken. Well, basically it's changing the parameters that make people eligible for mandatory outlays. And that's very, very politically difficult. But if you keep slamming the discretionary aspects of government spending to make room for the mandatory, you will have no public services left. And so the balance here is extremely disconcerting. And that's before I start talking about having the revenues to back this up. And this is where you start getting into some assumptions and picking holes in the official figures. The CBO baseline projection has very optimistic numbers in our view. Lots of revenue, lots of economic growth, lots of expenditure discipline. If you start questioning those a little and you say, well, what if revenue grows slowly? Or what if revenue just grows at its long run average? You start to get some very, very different outcomes for the overall debt stock. And those numbers should be unpalatable to the bond market, particularly if there was a competitor or an alternative to US Treasury bonds. And if you actually look at the deficit itself, I think there's actually some dangerous complacency coming through here also. The complacency is that because the bond market has never imposed any discipline on the Congress through the pricing of Treasury yields, the deficit is perceived not to matter. There's never been a funding issue, there's never been a pricing issue. And because the official projections, these are the IMFs, they're very similar to the CBOs, essentially people see the deficit on the improvement and they're happy to lock that in and say we're on the right track. The problem is that once you get beyond these projections in 17, 18, things deteriorate alarmingly as a combination of those mandatory outlays and ageing demographics hit very heavily. And that's where the debt stock starts to really explode from a high level, and you get those unpalatable levels of debt, which the bond market will certainly be looking askance at. So it's very, very frightening that we have these deficit doves out there that don't seem to make the connection between this sort of picture and the longer-term trajectory where the US's position starts to get to a point of no return relatively quickly in the 2020s without those very, very difficult decisions which Bates has discussed. And finally on that point, I recommend to you all the book by Simon Johnson and James Kwok called White House Burning, which gives a very, very detailed description of how you could possibly tackle these issues in the longer term, highlighting that tax expenditures are roughly equivalent to 7% of US GDP. These are things like interest rate deductions for owner-occupied mortgages, all the loopholes that businesses take advantage of, that wealthy investors take advantage of. So there is a very large honeypot out there, should the Congress choose to go in that direction. But once again, this is where we come back to the interest groups, the vested interests, which do drive the Congress, and that may be even more difficult than taking the decisions which we need in terms of the major parameters, and possibly even considering a national sales tax, where the US is a huge outlier in the OECD countries, where a couple of states have a sales tax, but there is no national equivalent to our own GST. So I'll end my formal remarks there. I'm very happy to take any questions you may have.
If October 17 doesn't go the way that is anticipated, what's Plan B?
It could well happen that this deadline, which is somewhat arbitrary, the 17th, I mean, there's a bit of flexibility there. It could happen that date will go by and there won't be an agreement. I think that's going to rattle markets probably, because we've sort of pinned our hopes upon that particular deadline. I would still suspect, though, that Plan B will be an agreement. It just may well fall after October 17th. I'm still relatively confident right now that there won't have to be this sort of Plan B. There will be some sort of temporary, near-term agreement to raise the debt ceiling and to reopen the government for some period. A few weeks, a few months, something like that. That's what I suspect. But what would happen? How would the markets react to blowing through October 17th?
Well, as I said, I think the markets have been very complacent up to this point, because we've done this so many times before, and it almost feel like we're just sort of going through the routine again. I think, though, that the US Treasury, as opposed to the White House, I think the US Treasury has become increasingly disinclined to do creative things to make the Congress look good. If you actually get through this period and the US Treasury has done something creative which actually forestalls something quite disruptive in financial markets, they may feel that they're creating some moral hazard inside the Congress. We normally talk about that with the financial system, but potentially there is some moral hazard. And maybe the thing that you actually need to resonate with Congress is dramatic share market declines. Multiple 100-point declines in the Dow tend to get politicians' attention. And that is something both sides of politics can agree is not a good thing, to be destroying American wealth. So maybe that's the thing, is the financial markets have been too complacent, and they haven't actually emphasised to Congress how worried they are about not getting through this in a benign fashion. They've been trained so well, if you like. Maybe they need a shock.
There's some politics in that as well. I mean, the Wall Street Journal has come out, very forcefully, trying to make the case that this sort of brinksmanship is going to be disastrous for markets and so forth. But then you have reactions upon the far right of the Republican Party that says, well, this is merely a problem for the wealthy elite of America. So maybe it's not such a bad thing. After all, they're the ones who created this problem in the first place. There's that sort of attitude, even on the right side of the Republican Party. So it's a very complicated political problem.
Who is sort of funding the Tea Party, if you like? Are the Koch brothers involved in all of this? What's going on politically as far as the drive that's behind the Tea Party? Because obviously there's big business interest there, and in some senses what the Tea Party is doing is not in big business interest.
I mean, I think big business is a large term and can often be, you paint everyone with the same brush. I think we're talking about very different types of people who have a very strong political agenda, such as the Koch brothers, who, while yes, they are a part of big business in the sense that they're wealthy entrepreneurs, they're very different from, say, the big business that gets represented, say, on Wall Street or elsewhere of a similar nature. I think for the most adamant of the far right on the Republican side of things, I think it really is a kind of ideological crusade. It arises out of a belief, which I think many very firmly hold, that the direction of the country is wrong, that the relationship between government and citizens has become too intimate, that government is too big, and that there is an agenda afoot on the part of the president and others in his party to sort of impose big government on the freedoms of the American people. I mean, I think many people very, very strongly believe that. But I think there's also an element to this that's more tactical rather than strategic or ideological. There's a tactical element here, where politicians see value in tapping into the, I would say, angst and anxiety that exists across a pretty broad spectrum of the American population about the future, about job security, about achieving the American dream, and all the rest. To the degree that politicians can tap into that and exploit it to their political advantage, there's a resonant audience that wants to have that, to feel as if their concerns are being represented. And unfortunately, because of how poorly the American economy has done for the past 10 years or so, there's a ready audience for that. And I think while many who want to represent those voices certainly don't want to drive the economy over the cliff and recognize the danger of doing so, nevertheless there's real political value in at least appearing to represent their concerns. And then that gets reflected in their willingness to play this kind of game.
Let's ask, if markets expect a deal to be brokered, and you still think there's going to be consequences for the economy, can we look at those consequences in Australia? So what would they be?
Well, there's a number of aspects of this, and it's the level of the Australian dollar itself, which is your first port of call here. Now, the thing which has driven most of the volatility of the Australian dollar this year, and has been considerable, was a move from above parity to the high 80-cent range when US monetary policy tapering was priced in. It didn't happen, and we quickly snapped back to the 94-95 area. So the implications of the political side of things taking flexibility away from the Federal Reserve to start talking about that again, and the unlikelihood of another window occurring to the Fed, actually locks in a higher Australian dollar than we might have had otherwise if this scenario had not emerged. And so that's a very, very clear takeaway for Australia's traded services industries, which are really struggling with the level of the Australian dollar. We think it needs to be about 70 cents for them to, not to thrive, just to have average conditions. So the current sectoral composition of employment growth in Australia, which we'd have liked to have seen more improvement with a lower currency, well, it's probably going to prevent that particular transition from occurring at the rate we would have liked. That then has implications for what the Reserve Bank needs to do, because the Reserve Bank is very anxious to see the exchange rate somewhat lower than it is also. And so that will actually potentially drive their thinking on monetary policy, despite the fact that we now have reasonably well-entrenched housing upturns in a number of major capital cities, particularly when you look at investor housing. The next point is the point about the global growth side of things. One of the most important inputs to your Australian economic growth forecast is your world growth forecast. You really can't escape it. And the cascading effects on emerging markets from a situation in the United States, such as the one we're looking at, means that the trajectory of global growth is going to be lower. The achievable ceiling is lowered, which has implications for commodity prices, which has implications for Australia's national income growth. So it doesn't end well for Australia if you have a global growth trajectory which doesn't meet expectations. It means that the negative aspects of our current situation remain up in lights, and the transitions which we would hope to see through shifts in that big, important relative price, the Australian dollar, isn't going to be flowing through. And so it is not a positive story for us at all. It's very difficult to spin it that way.
Do you think that Australia needs to revise its growth forecasts then for next year?
I think that global growth forecasts from the official family, if I can phrase them that way, which is Australia's own key economic policy organs and the international organs like the IMF, I do think they're too high. I actually put up that slide when I said that the 2.6 for the US should be below 2 and the 3.6 for the world should be below 3. They are quite substantial differences. A very, very different starting point for considering next year. As I've indicated, expectations are, and this is often the case with Wall Street, is everything will be okay next year. I know things don't feel great now, but we will bounce, we will bounce. This time the bounce was predicated on fiscal policy not hurting the economy in 14 the way it did in 13. We think that assumption is highly questionable, and we're also starting from a lower point in terms of the underlying veracity of the US recovery regardless. So absolutely, we think there should be a lower global growth trajectory in the minds of Australian policymakers, and that has very clear implications for policy making in the first half of next year.
Well, thank you very much. I think we'll run with that there.